How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options training program. And let's go ahead and get into it. So let me know if you can hear me. Highest paid part-time on the actual live stream, and also give me like a heads up of where you're coming from. We got like 7 people in the chat, so we're gonna go ahead and get into it. And what we're going to talk about today is how to buy options contracts on sale. So one of the biggest challenges that a lot of people are having is really what they're doing. Okay, Miss Lady L, I appreciate it. They're kind of overpaying for their contracts. And one of the detriments of overpaying for your contract is that, one, you're not as profitable as you could be because you're overpaying. Another downside of overpaying is that if you have to exit at a loss, not only have you having to exit at a loss, you also overpaid for it. So it's like you buying a car that is really, really expensive. And you probably paid more for it than you probably should have when you bought it. And then also, you got to turn around and sell it at a loss. And so that can be a problem. You're seeing a similar situation with Zillow right now. So I was looking at homes in a section of Atlanta early this afternoon. And I can tell that a lot of these homes are owned by Zillow because, one, I'm on Zillow. If you look at a lot of these homes on Zillow, it will tell you that they're taking 10% off the house off the top. Why? Because Zillow's trying to clear their inventory out. Well, what was the mistake that Zillow made coming in the gate? Zillow overpaid. So because Zillow overpaid off the top, because they thought the market was going to continue to appreciate, now that they have to exit the market, they got to take a loss on the house. So what happens? Not only do they lose at the top, they also lose at the bottom. And that's what people don't understand about markets. When you come into a market and you overpay for an asset or security just to get in, if you're lucky, you can exit with a profit, even though you overpay just to get into the deal. If you have to take a loss, not only are you taking a loss at the top because you overpaid to get in the deal, you got to take a loss at the bottom just to get out of the deal. And you're seeing that's what Zillow's going to have to do. And that's one of the reasons why Zillow sold off so hard is because they got to take a loss, and their losses are not done happening yet. And I also think those losses are going to spread to other parts of the particular economy as a result of their behavior in the market, because they, under the impression the market was going to keep going up. So it's the same thing when you're looking at options. If you go into an options chain and you overpay for the contract, right? If you're lucky, you can exit with profit, right? So even though you might have paid a little bit more just to get into it, you can exit with profit. If you're unlucky and you got to exit, you not only did you overpay to get into it, you also got to take a haircut to get out. So now you really get hit because you get hit at the top and the bottom. Over time, these are the things that can deplete your account. So when you're trading, yes, you start off, trading one contract, small position size, but you want to start developing good habits, because as you start to increase your position size, if you don't have a good habit of how to get in and out of the market, right, it can really harm you if something goes against you in the market. And we're looking at Zillow. Once the market went against Zillow, because they entered incorrectly, now they got to take a really, really big haircut. And I think that's what a lot of people don't understand. So a lot of people say their question is entrance. They're thinking that entry and exit means where they buy the actual contract at. No, it's, are you overpaying to get in the contract? And then if it doesn't go your way, what loss you have to take to get out of the contract? But like I said, most people think their problem is a options trader is everything outside of who they are as a person. And once they start to focus more on who they are as a person, it's going to put them in a better position. So we're going to kind of talk about that. Now, what you really want to do to get really good at this particular skill is you need to start looking at a lot of options chains. And I look at options chains all the time. And when I was starting off trading as an options trader, I would literally sit up at night and just look at options chains. And one of the things about Yahoo is it allows you to look at options chains and you don't have to log into your brokerage account, but you can log into your brokerage account also if you're on your mobile platform. Anybody that took my course knows about just downloading Webull to get alerts. And Webull also has an options chain on there. And Webull's options chain may be a little bit more up to date because they're a trading platform than Yahoo. But either or, it's a good way for you to get familiar with options chains. And so you just should keep looking at option chains all the time. And we talked about before, anybody that took my course, know you want to always be looking at open interest, because a lot of times open interest will determine what you're going to pay to get into that particular contract. Okay. And so I would encourage you to really get good at this, to start dedicating yourself to looking at options chains all the time. And you don't have to do an hour every night. You can just do 5 minutes a day. If you're somewhere and you don't have anything to do at that particular moment, go into your mobile app, open up your Webull or open up whatever trading platform that you're using and just start looking at options chains on just random stocks, because you'll notice that different stocks have different options chains. Also looking at the open interest, also looking at the dates, because this also impacts, right, what you're going to a lot of times pay for a contract. So certain companies that don't have a really robust options chains have monthly expirations, right? Other particular companies that are a lot more liquid have not only monthly, but they got weeklies. A lot of times that's going to determine how much you're going to be able to pay for the contract. I don't mean the overall price. I mean whether or not you can get those contracts on discount. And so these are the kind of things that you want to look at. So what we're going to do is kind of go through a breakdown of steps that you want to utilize to try to buy contracts on sale, right? But the most important thing to be good at this is you got to just start looking at a lot of option chains, right? And that's just something that a person will have to dedicate, because you want to be able to immediately look at an options chain and understand, well, one, do they have weekly expirations? Not saying you want to play weeklies, but you want to know how liquid the chain is. Do they only have monthly expirations? Because we understand that if everything is a monthly expiration, there can be a lot of volatility on that particular expiration date, which also can impact the value of your contract. So you need to know what you're getting into before you get into it. Then you start looking at things like open interest and volume. I'm not a big indicator of volume because I rarely scout plays on one day, but open interest is important whether or not you also like to factor volume in. So let's go ahead and go through this breakdown. If you got any questions, just hit me up in the chat. So the first thing you want to do is you need to look for a robust options chain. And what I mean by robust options chain, and you don't always need a robust options chain, but a lot of times it's going to put you in the best position. You want to look for an options chain in which there's a lot of market activity. So one of the biggest challenges that a lot of people have when they come into the market is they don't understand what a market actually is. So the stock market, the bond market, the real estate market, they're marketplaces. So what they really are is they're environments in which people buy and sell a particular asset or security. If there's not a lot of people in the market, it can impact what you pay. So let me give an example, and I teach this in the class. If you and I are going to an auto auction we're going to bid on a particular car. Let's say we're looking at just Benz, right? And a lot of people may know about the state auto auction. So you and I show up at the auto auction, and it's me and you, we're together, and the person that is selling the Benz. And they say, hey, you know what? I'm going to start the bid at, let's say, $50,000. But nobody else is bidding. Unless the rules of the auction don't allow me, I'm going to come under this person's bid. And they may not allow me to do that, but if they can, I will. Or if they say, well, you got to come over the starting bid, I'm going to bid as close as I can to the starting bid. Why? Because there's not a lot of people in this particular market for this car. There's not a lot of competition. If I show up at an auction to get a car and I'm trying to get this Benz and there's 100 people there, this is a very, very healthy market, which means that the price may start to ride up because everybody's here to get this particular car. So when you're looking at options chains, the best case scenario normally is that there's going to be a robust market for it, right? You want to look for a robust market. And how is a lot of times that indicated? You got a lot of open interest on that particular chain, which means you have a lot of people that bought that contract and they're just sitting there, right? Now, if you're looking for a day trade, a lot of times you can get a lot of volume. And you see a lot of that when you're looking at a lot of the major ETFs, some individual tickers like the SPY or the QQQ. You can sometimes see volume be way greater than open interest because on those particular tickers, there's a lot of daily trading of options contracts, right? So the CBOE in Chicago on those daily tickers, they sometimes do almost $1 billion in one day just trading those individual contracts, especially if it's a really big volatile day on either direction. So you're looking for a robust option chain. That's going to always create the best case scenario for you, right? Because the market maker is under more pressure to fill orders, and they don't care about giving you a sale because they make their money on volume anyway. Market makers don't make their money on individual sales. They make their money on volume. So essentially, they don't necessarily care on a more robust market. And a lot of times, because they're filling so quickly, they'll have conditions in the computer to fill a range of orders. So let's say, hypothetically, it's a very robust options chain, and the ask price from the market maker is number, whatever. They'll have a range or standard deviation up and down that particular number of what bids they're willing to accept. And you won't know that until you put a bid in. So, but when it's not a robust options chain, a lot of times they'll be less likely, right? Because they're going to do less volume on that chain anyway. So they're less likely to try to cut a deal for you because they're going to do a lot less volume. So one of the things you want to look for is a really robust options chain, right? And that's a lot of times indicated by open interest, but also by volume. And then also another indicator is that you have weekly contracts as opposed to just monthly contracts. It's rare that you see a company where they only have monthly expirations and it's a robust options chain. It doesn't mean it's not going to happen, but it's rare. You normally see it with companies that have weekly options expirations. And I'm not saying play weeklies. What I'm saying is that you're looking for an options that expire every week. The second thing you need to do, you need to plan your play. And that's where a lot of people make a mistake. Your play should be planned out. It shouldn't be because of what somebody told you. It shouldn't be because a headline flashed across the screen. You should plan the play out. So let me give an example. I knew on Sunday about Zillow dumping their house inventory. I don't know what I was looking at, something else that I had been looking at for a very, very long time. And I didn't play Zillow, but that really was the best opportunity for me. But you want to always plan your play out. So good traders have a plan, right? Even though the plan may, it may go to S once the market opens, you still want to come in with a plan. So it's like a football team. You spend all week putting your plays together. First play of the game, everything can get turned sideways, but your goal is to plan, because if you come into a game without a plan, it's impossible for you to win. So you want to know what the play is, because what a lot of times that can do is it can take away your anxiety and your desperation, because you've already planned how you want the situation to go. So you already want to know going into the play what you're willing to pay for the contract. So before I bought a contract, I've already looked at the options chain and determined what those prices are. Doesn't mean it's going to be those prices when the market opens, but I have a ballpark figure of what the pricing is and also what the implied volatility is. Now, it doesn't mean it's going to be that way when the market opens in the morning, but I know ahead of time what kind of, ballpark I'm actually operating in, as opposed to just waking up and then, at 11:30, looking at the options chain for the first time I've ever seen this particular ticker and then buying contracts, right? Because then you're in a position where you're chasing it as opposed to being in front of it, right? So let me put that down here. My bad. I forgot. You need to plan to play. Okay. Third, you might have to bid a few times. So this is what I mean. If the market maker has a particular ask and you put a bid in for it, it doesn't mean you're going to get it the first time you do it. So you may say, let's say hypothetically, the ask is $100 and you see that the bid from the market is, let's say, 97. You may try 95. It might not go through, right, at that moment. If you have time to wait, you can maybe wait and maybe the market will move that into your direction where you can get it for 95. Or you may say, okay, you know what? I put that bid in. It's been 10 minutes. It hasn't filled. Let me try 96. Then you can try 96. You wait 10 minutes. That don't go through. Let me try 97. Right? When you plan to play, you're not as worried and anxious about the play moving away from you because you have an idea where the play is going anyway. And the thing about options premiums, especially on tickers that are moving, they're constantly changing all the time. So you got to really know at what price will you not buy at if the thing moves, what price is unacceptable to you. At what price will you maybe say, you know what, let me step back away from the play and come up with a new strategy because this particular share price has moved is so far in a direction, it's really kind of outside of the range in which I want to play it. But you may have to bid a few times, just like you may have to do at an auction. If you're at a regular auction, you may have to put multiple bids in to get it. It doesn't mean you're going to get it on your first bid. The people that are looking to get everything on their first bid, and there's nothing wrong with that. I used to trade like that all the time because I just wanted to get filled. So we're talking about putting in a limit bid, a limit order, not a market order. You put a limit order in, which means this is the most I'm getting ready to pay for this particular contract, right? If you put that limit order in, you may have to bid a few times, just like you would have to do at a regular auction. But this is normal because you're in a market. And one of the things that we got to really do is start getting people to understand that you're in a market all the time. There's two things you're doing all the time in America. You're always in a market and you're always inside a contract. And most people have no idea of that. And once you understand those two things, and you can navigate the scenario a little bit better. You're always in a market and you're always inside somebody's contract. And you're always constantly affirming the contract by your participation in the contract. Most people don't have any idea. So it's harder for them to navigate scenarios because they don't understand these particular things are going on all the time. So just like any market, you may have to bid multiple times to get it filled. If you plan to play out, you have a good idea where it's going. You're not desperate to be in on the play. Bid a few times and see how it goes. 4, your bids might not work 100% of the time. Market maker just may not accept your bid. The market maker, for that particular reason, may feel like, you know what, I can cut these bids so close, I'm not going to accept nothing but the ask. And that can happen. You can be on a very, very, popular play. I was looking at Riot and Mirror calls this morning. I didn't like the IV. I felt like the options was really, really, really beefed up. I decided not to play it, right? Because I just didn't like the way it looked. I felt, even on weeklies, I felt like the contracts are too expensive for me to want to get in, because the market maker had already factored in the big move and really ramped up the implied volatility. The market maker may not accept your bid. So then you got to decide, do I want to buy these contracts at the ask price, right? Do I want to buy them at the ask? And if you do want to buy them at the ask, then it's just something that you got to deal with. So understand, just because you're doing this, it doesn't mean it's going to work, because a market maker does not have to accept your bid, and they may be less reluctant to accept your bid if we're looking at a particular contract, right, that's really, really heavily in demand and is moving really, really fast. They just might not accept it. You may have to buy it at the market price. So you may have to pay whatever the market is willing to buy at that particular price. But I want to tell you, don't get desperate. A lot of people overpay for contracts because they get desperate. Then if it doesn't work, like I said, they lose money on the top and they lose money on the bottom. 5, it's not about one contract. It's about saving money over a time period. So, you used to get these people, this is like back in the 90s. A lot of people understand things like Six Sigma, and you would get these people that could optimize processes in management and in businesses. And they would figure out, like, if I can save the company on this particular item, or I can save the company, 2 cents on every one of this item that we manufacture, over the course of a year, I've saved the company $250,000. That's money, that's free cash flow that we can put into another area of the company. We can hire more people. We can put that money into research and development, yada, yada, yada. You got to see your trading activities the same way. If you can save over the course of a year 3% on every contract, that adds up into $1 at the end of the year. That's free cash flow that you can put into something else, right? So you got to start looking at it. It's not just about one contract. It's about saving money over a time period, over that quarter, over that year. And then once you start to really understand how to do this, you'll find out that, you can save a few $1,000s a year on contracts just by utilizing, trying to get your contract on sale. Okay. And then over time, you go from saving to making more money on larger position sizes. The reason why this can be important to you is because we talk about get your percentage down and start worrying about your position size. As you start to buy, 15, 20, 30 contracts. I know a woman that I follow on Instagram, she bought 30 Visa contracts the other week, right? If you can save 3% on each contract, that's money coming back into your pocket, right? And then once you sell it, you really made more money. Why? Because you paid less than everybody else to get the contract. So then the contract becomes positive and makes more money for you. So you got to really understand that you can go from saving to making more money on larger position sizes, because over time you start to increase your position size. So you want to learn how to utilize this particular strategy and determine whether or not you think it's going to work for you in that specific situation. 7, if you just have to buy at that moment, it's not going to work. Most people are desperate to get into plays. They're desperate. And the market knows it by the way in which you're buying. So you got to get rid of the desperation, right? To be in the play. It's going to always be another play. Okay. This market is there's literally trillions of dollars. I think the New York Stock Exchange got a market cap of around 70 to 80 trillion dollars. There's not a lack of money in this market. So yes, you may miss out on this particular play. There'll be another play tomorrow. There'll be another play the day after that. There'll be another play next week. And one of the things that I learned is if I sit back and wait, plays just come to me. But a lot of times I feel under pressure to make a play that day. Well, what I found a lot of times, if I just sit back and wait and believe that a play is coming, plays just materialize because I'm thinking that I know a play is coming, right? But when a lot of times, if you're trading desperate, you're trying to make plays happen, which means you're trying to force your way into a play by any means necessary. And the market knows that, and then it's going to adjust its behavior based on what people are doing, right? So what I want to show you really quickly is some examples on options chains of what I'm talking about. So let's get right to it. Let me do that. So here is a company that just IPO'd not too long ago. I think they were an online education company called Duolingo. Now, I've been looking at this company because they had popped up to 200. I believe they were going to fall down. They have fallen down. They traded between like maybe 150 to 160 since they fell from 200. They don't have a lot of, and we'll show you a lot of trading activity. So if you can see that, let me see, can you see it? Okay, you can't because my head is on the screen. Okay, you can't see it. So the average volume is around 177. I'm sorry, the average volume is around 200,000. And it did volume today at 177. So a lot of times you see companies that trade under $1 million a day, their options chains are usually not going to be that robust. Why? Because there's not a lot of volume on this particular ticker, right? So that's always one early indicator that you're not going to have as robust of an options chain. One, it doesn't do a lot of trading volume over the day. This is very thinly traded compared to some companies that's doing 30 and 40 million and 50 million trades per day, right? So that's one kind of clue. So then now we go to the actual options chain. And I want to show you. So first thing we talked about, where are the calls expiring at? We got November 19th, December 17th. And let me see, can I blow this up a little bit? We got November 19th, December 17th, February 18th, and May 2022, right? So that's one of the issues is that there's not a lot of volume on this particular options chain, and the market makers have not created a lot of dates. So realize is that there's a November 19th, which is right around the corner. The next contract is expired December 17th, which is pretty much a month away. The next contract misses January, it's February 18th. And then the next contract after that is what, February, March, April, May is like a few months later. So this is not a really robust options chain. So you got to be careful playing this, even if you have a lot of conviction on the play, which is what I've been looking at, right? I had to stop myself from buying contracts on this particular play because the options chain is so thin, even though I knew this thing was going to sell off. So here's what I'm talking about. We're looking at the 150. So that's a November 19th call at 150. The ask is $8, right, which is $800. The bid is $690, and the last price paid was $770. So somebody got in for $770, right, even though the ask was $880, but they got in way above the last bid, right? So you may want to try to see if you were going to play this. Now, why is the spread so wide? Because there's only 103 on the open interest, which means there's not a lot of volume on this particular contract, and there's not a lot of demand on this contract. So the market maker really is not trying to work you a deal because they're not going to do volume on this ticker. So they're not really trying to cut deals on this. If you want to get in, you're going to pay. So we asking for $8. Last guy got it for $770. So he got $30 under the ask. The average market bid is $690. So if you want to get in on this play, you may try $770 again. You may try $775 and see if you get filled, right? But you're paying a lot more just to get in because there's not a lot of volume on this particular ticker. Looking at the 155 call, the ask is $6. The bid is $310, which is way, way, way off the ask. Somebody last paid $610. So the reason why this is higher because this is calls and this thing was red on the day, right? It was down 5%. So the last one that is probably sold, they could have sold this a week ago or 2 weeks ago because the last one sold was over the actual last ask. But the market's only bidding $310 for this. But one of the reasons for that is you got you got a 6-person open interest and you only got a 6 volume, but you got 80% IV. So this really, right to me right now, is not a really good contract. If we go down to the put side, you got the 145 put, November 19th expiration, 25 open interest, which is not that good. 820 at the ask, 740 at the bid. Last one was 610. Like I say, we don't know when this last 610 went through. We're looking at the contract that's in the money. That 634 is not that bad on open interest. I would potentially look at that. It's not that bad. The IV is a little high for a contract that expires November 19th, right? But you got 1060, right, on the ask. Last bid was 810, but somebody got it for 950 on the last price. Now, we don't know when they bought that, but they came in way under this last ask. So these are the things that you got to look at. When you're looking at a contract in which there's not a lot of open interest, there's not a lot of volume, you're a lot of times going to see really, really wide spreads, and the market maker may be a lot more reluctant to work with you on the price than if you get something that has a lot more volume. But you should always try it anyway. So if I was going to get this contract right here, this 1060, I don't know if I would bid 950, but I probably would bid 10, see if that went in, got filled at 10. maybe bid 1030, 1040. The problem is that it does such small volume and it's moving so slow over the course of a day. You're not going to get a lot of fast movement on your options contracts, which means what? They won't get filled fast if you come under the bid. So this is the thing that I want you to understand with a stock like this in which you don't have a lot of volume. If I come in under the 1060, so like, let's say I want to just get filled immediately. I'll put in a limit or a market order at 1060. I will get filled immediately, right? Especially if I put a market order in, it'll probably get filled right after 1060, maybe a little bit higher. But if I put in under that particular 1060 with this slow moving ticker, it may take me a long time to get filled. And so then by the time I think it can get filled, I may have to change my bid to something a little bit higher to try to see, can I force my way into this particular options chain? So these are the things that you got to look at, right? Let me see the next one. And I'm going to show you something that's a little bit better from an option standpoint. I don't know why that blue face is there. Let me talk about forward. And then first, let me get rid of this particular banner. Let me hide that. My bad on that. Okay, that's cool. Okay, so looking at forward, and this is why I tell people, if you just start out trading, forward is a good place to, like, as a good sandbox. So the first thing I want to show you is looking at Ford Motor Company. Today they did 163 million in volume, right? So they're massively traded. Their average volume is 72 million. So they're traded at a very, very high level. So it helps you as an options trader because it's going to be easy to get in and out of contracts. They're going to get filled extremely quickly, right? Because you're looking at a ticker. Even though nobody really talks about this company does a lot of trading volume every day, and it's been doing a lot of trading volume ever since I've been in the market, right? This thing is a massively traded stock. So the market maker really ain't tripping on no individual price because they're going to get all their money on volume. And they get half a cent on every share sold. They making millions of dollars every day on forward. So they don't care about, they're not really tripping on selling you a stock a little bit under the ask or even an options contract because of the volume that they're doing. So let's go to the options chain. So now, first thing, what we talked about before, looking at the options chain, what do we see? We see weeklies, 12th, 19th, 26th, 3rd, 10th, 17th, 23rd. Then we go from July. Now it jumps from the 23rd of December, which is, right after Christmas, to July 21st to 18th. But I'm telling you, as we get closer to December, those later December contracts and those early July contracts will start to fill out. They just haven't filled them out yet. But as we get closer to those dates, they'll fill those contracts out because it's forward. And they're doing the volume because the market maker know if I make a market for these contracts, I'll sell them, right? But as of right now, unless we're looking at buying leaps, we got contracts going all the way out to December 23rd, right? So we got a lot of, this is a really robust option chain. So let's look at the November. I don't want to look at the 12th. Let's look at the 19th. Looking at November 19th, the 2050 call. I got 92 on the ask. I got 91 on the bid, and I got 94. Right. So this is really tight between the bid and the ask is 1 cent. I would try to see, can I get this for 90 and see what happens? Right. Maybe even try 89. But one of the reasons why I can do that is because it's 17,000 on open interest and 12,000 on volume. But the IV is a little high, but I guess they feel like Ford is in a bullish pattern. Looking at the 21, I got 77 on the ask, 76 on the bid, and 79 on the last sold. I would try to see, can I maybe get this for 75 or even, like I say, 76. If we go down to the put side, right, I got 109 on the ask at the $20 put, 107 on the bid, and 109 last field. 3,000 open interest, 2,300 volume. So I would try to see, maybe can I get this for, I would maybe even try 105 on this. Because in a scenario like this, let's say I want to buy $1,000 worth of contracts. I want to see, can I save $4 or $5 a contract? And the reason why we developed this strategy is many of us was trading before there was no commissions. When you had a commission to where I first started trading, I was paying, I think TD Ameritrade, I was paying, I think $7 on every side of a play. So to get into the play, I had to pay TD Ameritrade $7. To get out, I had to pay $7. Then I moved to Alley where I was only paying $5. Then everybody moved to no commission because of the Robinhood effect. So one of the reasons why we developed this is because we understood this is really how the market maker makes their money. And we wanted to let them make their money on somebody else and not make their money on us, because I wasn't buying volume when I first came in. I was buying one contract. So once I added in my commission that I had to pay the brokerage or the trader or the trading platform on every particular call, I had to increase my percentage of profit just to justify me being in the play, because I had to factor in the expense of enter and exit in the play. So this is one of the reasons why we developed this, is because we used to have to pay just to get into plays. Now everything's pretty much commission free. You're paying like 50 cents to get into a play. But it used to be you had to play sometimes $10 or $7 or $8 on each side of the play just to get in, which means that you had to factor that into your profit, or also factor that into your loss. Because if you had to take a loss, you still had to pay the commission. So this is one of the reasons why we developed this particular strategy. Let me look at it, show you another one to where it's a much more robust options chain, right? Let's go here. But I like forward contracts as a good place to kind of learn how to trade. Let's go to Apple. So we're looking at Apple. Now we got Apple Incorporated. What did they do today? They did 52 million in volume. They averaged 75 million. So this is a very robust ticker, right? Does a massive amount of volume. So the market maker just plays this as a volume play. Look at the contracts. So we got November 12th going all the way to the 23rd, and the same thing. We go through 23rd, it jumps to January. But once we get into the mid-December, they will expand out those contracts for December, January, and probably February, right? And then we got contracts on Apple going all the way out to 2024. So we got leaps going out. Really, most leaps only go out 2 years. We got leaps here going out almost 3 years because of the amount of activity on this particular options chain. So let's look at the November 19th. And what we're seeing on the 152 call is what? 147 on the ask, 143 on the bid, and 147 on the last sold. I would try to get this contract. See, could I get it at 145? And we see these contracts are appreciating. 27,000 on open interest and 30,000 on the volume. I like that IV 22, right? Now, Apple's not a big, strong mover unless there's a lot of news behind it, unless there's a catalyst. But Apple contracts have very, very low IV, and they're not that expensive on the shorter term contracts. Looking at the 155 is 76, 75, and 76. You might be able to get in here at 74, but you got 91,000 on the open interest. Now, when I look at these open interests, understand this isn't retail. These are institutions on these particular options chain, because there's nobody on retail that's doing 92,000, 91,000, and 93,000 in open interest. Because you take these contracts, you multiply by 100, and that's how much this options chain is worth. So we go to the put side. We see 169, 168, 175, right? This may be because they last sold this as this thing started to move. So we're looking at Apple, where it finished green today, so finished up 0.25. So they might have bought these contracts before the move. So they paid it before these contracts started to lose value. But you got 32,000 open interest, 9103. So if I wanted to get into this, I would see maybe can I pay them 166 or maybe 165 and see if it works, right? And so these are the kind of things that you want to do, is really start to study options chains and understand like what makes a robust options chain, what makes a thin options chain. And if you're trying to force your way into plays, like I think this Duolingo play, will it come up? I think this Duolingo play is a good play, right? But you got to realize that it's a thinly traded ticker. So there's a lot of risk that you're taking to get into this play, right? But I was going to look at, I think I was looking at, was it December or February puts on Duolingo? I might have been looking at February puts on this. I don't know. But if you look at like the end of money put, it's 168. They want 2380, 2660, and 170. So this thing is so broad, and it's really, really expensive to me. I don't know if I was looking at the February's or the December's. I was looking at one of them for puts, but there's really no open interest on this chain. Very little to no volume, because it's a thinly traded ticker. Now, there may be a catalyst to make people start to run over here, because you see people are picking up these contracts. But these could just be hedges, not necessarily people trying to trade it. Because you see, even deep into the money, there's really nobody on the chain. There's nobody on the 270 put, right? So even though they got a price there, nobody's bought it. It doesn't have any volume. So you got to realize when you're getting on these thinly traded options chains, you're taking a lot of risk, because this is what I want to tell you. Even if you get the movement that you want to get on this, right? You can put your sell in to sell the contract on the ask. it doesn't mean you're going to get it because you still got to worry about the bid. So when you're looking at a ticker like this that's thinly traded, it doesn't have a really robust options chain, you can get the movement that you want. But if you wake up and there's still 25 open interest, it means what? There's not a lot of demand on this particular contract. So if there's not a lot of demand on the contract, the market maker will fill you, but it doesn't mean they're going to fill you at the price that you want. So you may have to take a haircut just to get out of the play. And this is what a lot of people don't factor in. I wouldn't play these type of plays until I had a lot of experience in the market, because you got to be able to anticipate every contingency plan in which things might not work for you. So if you know about Alabama football, one thing Nick Saban's really good at is he gets with his staff and he says, let's ask ourselves everything that can go wrong and let's create a plan for that. So everything that can go wrong, let's create a plan for that, because it can happen, right? Murphy's Law was in effect. So a lot of people will get on these particular tickers and not think about, well, what if I can't sell the play this particular 145 put? What if I can't sell it at 1360? Because I'm going to be the second person on the play, open interest of 2, right? The bid is 1270. So you got to take a haircut just to get out of the play. And you might not get to 1270. You might have to sell this for 1250 just to get out of the play when you want to get out of it, because you can put a 1270. You can put the 1360 ask in as a market and the contract can just sit there. And you're waiting for the market maker to come get you out of the play. And their attitude is, well, we're not really tripping because there's not enough volume on this ticker for us to really be pressed to get you in and out of this play that fast. They'll get you out, but they may not get you out at the price that you want to get out of. They're the buyer and seller of last resort, but it doesn't mean that they're going to give you the price that you desire. So that's something that people got to understand. So that's pretty much what it'll be. So I want to really encourage you to start applying this to your trading, because like I said, is that it can save you money over time. It can make you more profitable over time. And you really want to start to utilize this when you start taking bigger position sizes, which eventually you'll start to do. As opposed to buying one contract, you might start buying 3, then eventually you might start buying 10, then eventually you might start buying 30. And so you want to utilize a particular strategy of getting in and out of plays, irregardless of how many contracts you buy, and just kind of make that the rules. Because if you were trading for a firm, they will make you trade the same way, regardless of your position size or regardless of your contract value. There would be an SOP that you would have to follow. And if you didn't follow the SOP, they will fire you, right? Regardless of whether or not you're successful, because they want you to trade a certain way. So if you can start trading under a particular script and just figure out a script that works for you, I think it can put you in a position to be a lot more successful long term. So if we got any questions, let me know. So we got any questions? Let me go through the comments, see if we got any questions. But if you got any questions, hit me up in the comments. Okay, so Jigga 1017, what I want to suggest to you is sit back and do research, right? So one of the best things that's going to help you as a trader is not expect somebody to give you the answer, be willing to do the research. So we showed you on one ticker, Ford. So I would get a scanner like FinViz and take 2 hours of your day, maybe on the weekend if you're not working, and just look at trying to find tickers in which contracts are a lot less expensive. And just be willing to take 2 hours trying to find those tickers, because they're there. They do exist, because I know. And they're really not as hard to find as people think they are. But I would encourage you to get out of the mentality that my problem as a trader is going to be solved by somebody else giving me the answer. Look to get answers to larger macro situations, and look to be able to solve micro things on your own, right? Unless you want to like pay people just for consultations all the time, because it's not hard to find $25 to $70 contracts. You just got to be willing to sit down on your computer and maybe spend 2 hours just looking for it. But if you want the market to be profitable for you, you got to be willing to make that time investment. But that's a good question, though. So how long are my swing trades normally open? It's going to be situational. So it'll be based on that particular play. So everything about that would be situational, how long I have to play open. But I don't play a lot of weeklies, though. Yeah, I feel you. That's going to be situational. So the minimum, there wouldn't be a minimum volume. when I'm looking for a swing play. Minimum open interest, that's going to also be situational. So ask yourself, what open interest do I need to be able to exit the play at the price that I think I want, right? So we talked about before, look for a robust options chain. And if you took the course, I gave you a number of open interest to try to use as a baseline, but it doesn't mean that that's what you're going to use, because that may be something that doesn't work for you. But you want to ask yourself, based on you trying to exit, what open interest works for you. And then also you can paper trade and you can experiment on open interest and figure out, based on your experimentation, what allowed you to get in and out at the price that you wanted to get in and out on. Yeah, you use Thinkorswim is really robust. I don't really use them. I need to start getting into it. To look at when is that last thing. I feel you. Yeah, if you don't have a plan to play something, I wouldn't play it. Yeah, they're gonna make all their money on volume, But the issue is that if they get rid of payment for order flow, we're gonna go back to having to pay to trade. And a lot of people that don't know how to trade, they're gonna get forced out because they already don't know how to trade, and they came in because of no commission. Now, when they make it to where you got to pay a commission just to trade, a lot of people are not going to be able to deal with the space anymore. They're going to get forced out. That's why people really need to really focus on trading. But, the no commission platforms brought a lot of people in, and that's not a good thing. That's not a bad thing. It's a good thing. But they're talking about maybe getting rid of payment for order flow. They get rid of payment for order flow, a lot of the platforms are going to make you pay to trade again. And a lot of people that really don't know how to trade, they're going to get scared off by the fact that you got to pay on both sides of the particular trade to get in and out. Sometimes if you're looking at similar open interest on a call and put side of a strike, it could be, I think, a straddle or a strangle. I forgot which one it is, but it's when somebody buys a call and a put, almost like a hedge on the strike on the same date, same price as a hedge. And it doesn't mean it doesn't mean that that's why they did it. It can be the reason why they did it. And what it can mean is that the price may not move in one direction. It may stay in between. It may stay either in between those particular prices, or it may stay on one side. So those are kind of things that you got to look at, but it doesn't also mean it's going to happen. What's going to happen in the market is what's going to happen. But the options changes sometimes can give you some insight on what you think might happen, but also what you think might not happen can be what can happen. So it's just something that you want to look for, because what a lot of times you want to look for is the options change slated in one direction. Not necessarily is it even, because if it's even, it may just trade flat, and you don't want that either because of theta decay. See, so reach out to Chastity, because she can show you, and she does consultations. She can show you how to get them cheap contracts. So this is skill, but I'm telling you, to save you a lot of money, to make you a lot of money. And like I said, is if they go back to making people pay to trade, you're going to need to know how to do this, because this is what I learned how to do when I had to pay like $7 for each swing, because I had to add that to my profit. Right. So I learned how to trade in a different environment where it wasn't as easy to get in and out of this market like it is now. A lot of people came in, it's a free for all out here, but it ain't going to last like that forever. Yeah. FinViz. And so I look at FinViz every Sunday. And I would just tell people just be willing to spend like an hour, 2 hours on FinViz, or I don't matter if it's 15 minutes a day, just get used to it. Mr. Jameson, I would encourage you to get on FinViz and start looking through a lot of stocks. And that's how you'll find them. Just get on FinViz and start putting that work in. That's really how you'll get it down. Appreciate it, PhD. Yeah, Mikhail G, the reason why I'm not a big fan of Delta is because Delta is driven by implied volatility. So what I'm not a big fan of telling people that a snapshot of a play is how the play is going to move, because it's not. So I'm more of a fan of teaching people how to really understand volatility, because as an options trader, what you're doing is you're either purchasing volatility or you're selling volatility. But delta moves based on volatility. So to me, I'm more of a fan of teaching people how to understand volatility, because just because the delta is 0.48 at this moment doesn't mean the delta is going to be 0.48 30 minutes from now, right? Doesn't mean it. So people use delta as a determinant of whether or not they think the return on the contract is sufficient for them to buy it. But if the share price moves in the other direction, then the delta is not going to stay the same anyway. So to me, I'm not a person that tries to utilize Greeks to paint by numbers, because they all change. So my question is, what drives the change? The IV. So that's all I'm worried about. To me, contracts are valued on IV and theta. Nothing else is the real. Everything else is to me lagging from a Greek standpoint. So to me, IV and theta determine the value of the contract. Those Greeks drag the rest of the Greeks along. So I'm more concerned about people understanding IV, what implied volatility actually is and how it impacts contract volume, and theta, then worrying about data and delta and vega, because they get a lot of Greeks inside their head that change all the time anyway. So let me give an example. People bought puts on car right after that big move. Well, what did they do? They bought a lot of volatility. So they bought puts on car when it was $300 something. They purchased a lot of volatility. November 19th expiration, because car only has weekly expiration. Car only has monthly expirations. Car the next few days traded sideways. So what happened? You got volatility crush. So your premiums went down because of volatility crush, not because of delta. Because you purchased a lot of volatility, premiums went down because of volatility crush. Still got the November 19th theta. Every day you get closer to November 19th, especially on the weekends, theta crush starts to also harm your premium. Delta and Vega don't have anything to do with it. It's you purchase a lot of volatility because you purchase contracts in an extremely volatile situation. The worst time to purchase a put is after a massive move like that. Why? Because the market makers factor in volatility into both sides of the options chain. So I think a lot of people got to really, we still, like I said before, and I talked about this in an earlier video, we see the things as compartments. I see 360. And I try to understand 360 and then break it down into compartments, as opposed to understanding compartments and then try to figure out what's the 360. So I go 30,000 and then go down to the micro. I don't go micro and then try to go up to the 30,000, because to me, that doesn't work that way. So I think a lot of people fail because they think they can learn individualized parts of the market and then make an inference on the macro. The way I learned economics is they taught us macroeconomics first, then they taught us micro. But a lot of people look at stuff micro and then try to infer macro. Well, that's not how statistics works anyway. Statistics is always macro, then micro. But that's just my personal doctrine. So the way I teach it is I teach people understand the two Greeks that drive everything else. And then once you understand those, you'll understand why they're moving everything else, because those are going to move based on those other Greeks. Delta doesn't move IV. IV always moves delta. And theta is going to be there regardless of what happens, because it is a hard expiration date, so you can't change it. You're using FinViz as a study. It's a free platform. They got a paid platform, but they're using FinViz as a study. So it's something I still use to study. And they're a good platform, unless you want to pay for like Trading Desk or something like that. But they're a good platform that's free that you use to study. A lot of the stuff that you need to learn about the market, you don't have to pay for. You just got to be willing to do the study and sit down and do it, and then you can pay somebody like Chastity. She can walk you through some of the things that you're missing, because I'm a big fan of just telling you to just sit down and just study, right? Just be willing to do the study. But you can pay somebody like Chastity. She can give you some pointers on a consult, and then, it can accelerate your ability to kind of learn what you might be missing. But if you come to me, I'm gonna just tell you to open up FinViz and just sit down for 2 hours and just, go through that thing till you figure it out. And you'll figure it out if you spend enough time at it. It's not complicated. You just gotta be willing to put the time commitment in. I'm not a fan of averaging down because to me, if the play moves against you, I'm not a fan of averaging down into a losing play. But some people do. That's how it works for them. That's how they've been taught. I know a guy that's a hell of a trader. He averages down. I don't. I exit the play. I'd rather take a loss, reformulate my capital and then move into another direction. But I'm not against averaging down. But I don't believe in averaging down on stocks either. So I'm not a fan of buying into a losing position. I would rather exit and then figure out what I want to do next, as opposed to buying into a losing position. But everybody learns how to trade different. I know a guy makes a lot of money in the market. He teaches averaging down. My thing is that how you average down if you don't have the account size. So if you're trading with $250 and you spent $20 on 4 contracts and the play goes against you, why would you spend more money to average down? You're taking more money out of your account on a losing play. Right? So that's why I don't teach that. But my market that I teach to aren't people that got $20,000 in their account. That's why I don't teach it. So, everybody got their different doctrine of the game. Yeah, Apple's really, because the IV is not that high. So that's why I try to get people to understand IV. Apple contracts are really not that expensive because the IV isn't beefed up like some tickers, like Tesla, where the IV is just crazy. Now, I look at it to see hedges. Sometimes you can see, people doing spreads and stuff like that. That's what I look at it for. Normally, that's what I'm looking at. But like I said, it's not always 100% because a lot of things impact share price. And sometimes the options chain impacts share price. And sometimes that thing's going to trade the way they wanted to trade, like CAR. CAR, the options chain did not make that thing go up to $500. That was somebody that kept deciding they was going to buy it at a higher and higher price. So a lot of things can impact share price, not just the options chain, but sometimes the options chain can be driving share price. So you got to kind of really understand on a macro level what's happening and then push it down to the micro. And it's always going to be a case-by-case scenario. So when I tell everybody, if you're new to the particular platform, go to the www.thehighestpaid.online. It's an options trading academy that we created for 3 types of people. These are the people that, one, are not satisfied with the amount of money that they're making. They're not satisfied with the amount of time that they got to take away from their family to make that money. And they also don't like the fact that there's a cap on their income. So we're going after people, and even this whole platform, and I may talk about this later, my goal is to market to people that know that they have a problem. My goal is not to try to convince you that you got a problem. So if you know that these things are a problem for you and you want a solution, right, that has been proven to bring about results and you're willing to do the work, it's something that we talked about on this particular broadcast. You're willing to put the work in. This can be a good solution to you, but you got to be willing to invest in yourself. And you got to be willing to do the work to get the results that you say that you want. But the biggest thing is you got to know that you have a problem. I'm marketing to people that know that there's a problem. I do not desire to try to convince people that they got a problem. That's not my job. So if you want to be convinced you got a problem, I'm the wrong guy for you. I want to go after people that know that they have a problem. They know there's something wrong with the world and they're looking for a solution to it. And they want to work towards a solution, not just sit on YouTube. So we got any questions before we jump on out of here? Yeah, I don't look at Delta either. I do look at Delta right before I buy it, Michelle Green, but I don't care what it is, right? Because to me, I know that IV will make the Delta go up. So let me give you an example. I got Peloton puts. When I bought Peloton puts, I knew that thing was going to sell off. So I knew that the IV would bring the Delta up, right? So IV drives Delta. Now, if you're maybe a day trader, it can be a big deal. But I really scalp. You gotta go reach out to Mecca for that. I'm not a scalper, right? I'm still learning how to do day trades. But for longer swing plays, I'm looking for a big directional move. And that IV with that directional move is gonna drive that Delta up because of the IV, right? So that's what I understand. So I understand on a macro level. I don't really look at Delta. I do look at it right before I buy it, but I'm really looking at IV and I'm really looking at open interest. And I'm looking at IV because IV crush will kill a contract. I've had contracts that I bought them, but because of IV being spiked, I paid a lot of money for them. I got the direction of movement and still lost money on the play because it didn't move in line with the forecast, right? So the delta was irrelevant. It was that IV. That's really what drives that play. It doesn't really matter to me, but it's all situational. So my question is, what is the lowest risk way in which I can make money? For most time, to me, it's swing plays. But I know people that I trained, that I taught, that's really, really good at day trading. Like they're experts at it. Like they should really create a course and pay and charge $10,000 for it. That's how good they are at it, right? They just don't want to teach. But I know somebody that came out of the program that's like an expert day trader, which is extremely hard to do, right? Swing trading is way easier than day trading. There's a lot of stuff you got to watch on the day trade. So I'm still getting my feet wet on short-term scouts. But I'm better at swings, and I'm also better at the downside of the market. Molly, 80% of my plays are puts, right? But you have to learn the fundamentals and then develop into what type of trader that you really fits your personality, your budget, things of that nature, as opposed to trying to copy somebody else. Most people can't do what I do because most people don't understand put contracts as well as I do. So they can't do what I do. But it doesn't mean because that's what I do, that's what you have to do, right? Just Fatima, I don't trade warrants, but I know about them. But I was worried that if I spent the time to learn them, once this SPAC blitz was over, would they even still be relevant, right? Because I was going to go learn warrants, but I was worried about once this SPAC run is over, would they even be still relevant? Like, would there still be a market for them? I didn't want to spend the time to learn it because it's separate than options. And then the market for them in 6 months to a year contracts. There's not a lot of liquidity in the market anymore. And then I just kind of wasted my time learning it because I would only be learning it to try to teach it to somebody else as a way to make money. I'm a big believer that we got to figure out how to make money regardless of what's going on in the world. But if that particular marketplace would start contracting because people would start moving away from SPACs, then it wouldn't even be relevant anymore because there would be a lack of liquidity in that market. Within there's not a lot of market. That's why I haven't run over there to learn how to trade warrants. But I know about warrants. I'm familiar with them, but I haven't really taken the time to learn how to trade them. But that's a really good question. That's a really good question, especially if you're looking at the SPAC game. So want to encourage everybody to go to the www.highestpaid.online. We got any questions? I want to ask everybody if you haven't liked the situation. So we got 49 people on the call. I'm sorry, on the broadcast. Let me see. Do I got 49 likes? I got 35 likes. Okay, so we still a little bit off. So like the particular video. And we got any questions before we get up on out of here? I don't know who that is. Okay, good job on warrants. All right, Mike G, I appreciate it. Okay, Rich Alexis. So in the VIP course, we have a mindset counselor that's a trained therapist that can help you with that. So if you believe that's a big enough problem and you are looking for a solution to that problem, I have somebody that can help you. Right. So when you decide that it's a big enough problem and your lack of success is a big enough problem, I have a solution for you. So when you make that decision, let me know. Right. But the price down the road won't be what it is currently today. But when you make that decision, let me know. I can tap you in. And because we got a comprehensive plan to solve that problem, because most people's problem with trading is they self. It's not trading. It's them. But it's the same problem they had their whole life. All right, Sean Douglas, I appreciate it. Okay, so that's pretty much going to be the show. All right, so David W. Williams, also known as Diamond Dave. Like it, share it. Try to make those likes hit those particular streams. You're still on 36 likes. Some people probably jumped off. Be easy.